Okay, so the market hit all-time highs again for the 29th time this year. You might have money on the sidelines and you're thinking, do I put money to work now or do I wait for a market correction? Or maybe you have money invested right now and you think, do I hit the exits? We've hit the all-time highs. We're bound to hit a market correction. I'd say at the end of the day, it's not about timing the market. It's about time in the market. And so during times like this, I often think WWLD. What would the legendary investors do? And so I thought we can go over Warren Buffett, Charlie Munger, Peter Lynch, John Bogle's legendary quotes about long-term investing and focusing on that long-term investment horizon. And then from there, we're going to look at some really interesting graphs that look at historical data that really proves and underscores the value of long-term investing and having that long-term investment mindset. And finally, we'll discuss the historical implications of rate cuts and what that's meant for stocks and bonds over the last 40 years. Now, I'll give you a quick little preview. It's a positive thing more often than not. So that's something to look forward to if history repeats itself. Okay, we'll start with Warren Buffett. The stock market is designed to transfer money from the active to the patient. This quote underscores the importance of staying invested for the long term rather than trying to time the market. So as we know, the market will naturally have drawdowns over the course of any year. And for those maybe that do have cash on the sidelines, an approach, instead of piling all your money all at once, you can dollar cost average, a certain percentage every month over the next couple of years. By spreading out your investment over time, you can buy shares at different prices, potentially lowering the average cost per share and avoiding some of that market timing challenges, if we do see a correction over the next several months. Next is Warren Buffett's right-hand man, Charlie Munger. The big money is not in the buying and selling, but in the waiting. This highlights the importance of patience and the benefits of a long-term investment horizon. All right, next is the Magellan Fund wizard. That is Peter Lynch. He says far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. So this really emphasizes the futility and risk of trying to predict market highs and lows. Next is John Bogle, the father of index investing, Vanguard. Time is your friend, impulse is your enemy. As a reminder, stay invested over the long term, which will generally yield better results than reacting impulsively to market highs or lows. So I've been working in the investment industry for over a decade now. I get the opportunity to meet with some of the brightest minds, money managers, economists. Now, does that make me one of the brightest minds in the industry? No, but I learn a lot and I want to share a lot of what they share with me. I think this is super valuable. And so I hope some of this you find useful and helpful for your investment journey. Okay, so investing at all-time highs. So in this graph, we have the S&P 500 index plotted, and the green marks represent the all-time highs that set a market floor. And so the market floor represents an all-time high from which the market has never fallen more than 5%. And so since 1950, there would have been many instances in which an investor sitting on the sidelines with markets near all-time highs would have never seen a better entry point. So yes, there's likely going to be another market correction, 5, 10, 15%. No one can say for sure, but just know that over time, there might not be a better entry point than we are today. And the second graph is actually quite interesting as well. It looks at the average cumulative S&P 500 total returns of investing on any given day over the last 35 years versus investing at a new high over 3, 6, 1, 2, and 3-year time periods. And it actually shows that returns from investing on any given day versus the all-time highs are actually comparable, and in some cases, even better when investing at market highs. So the next graph looks at time, diversification, and the volatility of returns. So as you can see, over any 1-year time period, stocks can be up as high as 52% or as low as 37%. Bonds, a little more narrow, 33% to 13%. The 60-40 portfolio, 34% down to 20%. However, if you go over longer time periods, the potential chance for negative returns becomes less and less. And so, as you can see, over the last 70 plus years, over a 10 and 20-year time horizon, and rebalancing annually, a stock bond portfolio has never produced negative returns over a 10 or 20-year time period. Okay, so how about we look at the US stock market and see how things have looked over 10-year time periods over the last 100 or so years. So this is, I thought, an interesting graph here. So the best 10-year annual return was 21% for the period ending towards the tail end of 1959. That's a total return of 600%. The worst 10-year annualized return was a loss of almost 5% a year, ending in the summer of 1939. And so many of you can guess what that time period was. This resulted in a total return of negative 40% over that time period. And as we know, the 1930s were a little rough. The only other time the market has experienced negative returns over 10 years was starting with the bursting of the dot-com bubble at the start of the 2000s, followed by the GFC towards the end of that decade. Okay, and as we go out even further, looking over 20 years, things get even more impressive. So the worst 20-year return was a gain of less than 2% ending in 1949. Think about that. This includes the Great Depression as well as World War II. And another thing to note about the 20-year time horizon is that the distribution of returns over 20 years is almost 90% of the time, annual returns have been 7% or higher. Annual returns were 8% or more in 75% of all rolling 20-year observations. And they were 10% or higher 56% of the time. The 30-year graph is probably the most stunning to look at. The lowest annual return over any 30-year time period going back 100 years was 7.8%. Think about that. So even for those investors in the 1920s, where they would have lost more than 80% of their portfolio during that time period, by the end of that 30 years, they would have still made more than 850% over the 30-year time period. So in other words, the worst 30-year return over the last 100 years or so was a total gain of 850%. The best 30-year annual return was 14.8%, ending in 1968. If you're still with me, that's awesome. Let's look at what a rate cut environment tends to look like for stocks and bonds. We're likely going to be in this environment this year, and most definitely, by the sounds of it, next year. So what does that mean for your stock portfolio? What does that mean for your bond portfolio? At least looking back at history and what that has looked like. First graph here, the S&P 500 returns around the end of a Fed hiking cycle. You can see here the majority of the time over the 12 and 24-month time period, stocks have been positive. You can see the 1999-2000 dot-com bubble era. That was obviously extremely challenging. 04-06 was another challenging time period. But the 88, 2015, 83, 1994 time periods were all in positive territory. And so looking at the bond portfolio historically, as represented by the US 10-year here, returns after the last rate hike have all been in positive territory, even in the 1999-2000 dot-com bubble. That stresses the importance of diversification in different asset classes. And you've got 1994, 2004, 15, 88, all in positive territory. And just as a refresher, when interest rates get cut, bond prices tend to go up because the new issuances of bonds are going to have lower coupons. So the higher coupon bonds outstanding are going to be sold at a higher price. And so that's why there's that inverse relationship with bond prices and interest rates. Okay, so that is looked at the last rate hike and sort of the returns over 12 and 24 months. What about after the initial rate cut? So here we look at the last 11 rate cuts going back to 1982. So you can see on average, the S&P returned around 8.7% and 17.2% over the 6 months and 1 year following the initial rate cut. Positive equity market returns were observed in 9 out of these 11 rate cuts. These 2 exceptions occurred during particularly challenging time periods. So this was the dot-com bubble of 2001 and the subprime housing crash in late 2007. Bonds, on the other hand, managed to achieve positive returns during those challenging market conditions in 01 and 07, highlighting again the benefits of diversification within your investment portfolio. And for fixed income, there was that time period in 1998 where they did face some challenges. For those curious, go ahead and check out the Asian financial crisis of 1997, extending into 1998, or the Russian financial crisis. And another really interesting story was the collapse of long-term capital management. We won't talk about that today, but go ahead and give that a Google. There's some pretty interesting stories there. So remember, the best time to start investing was yesterday. The second best time is today. So I wish you the best of luck on your investing journey and stay focused on the long term. And over time, you should be rewarded handsomely. So we'll see you next time. Take care.